As you look back to 2012, when you first had this vision to solve these credit issues within structured notes and create these defined outcome investments, inside of 40 Act funds, I'm curious to know if there are any surprises along the way. I always find it's interesting when founders start out on a journey, they have one thing in mind and then they learn other things along the way. So tell me about any surprises that you learned along the way.
Yeah, no, it's an interesting question. I mean, it's been a fascinating journey and a very fulfilling one for us, with Cboe's partnership to take what was an initial idea to billions invested today. And yeah, so I think I recall when we went into Cboe almost a decade ago, we told them how we wanted to bring these defined outcome investments to the market, but not as products that were going to be backed by balance sheet or the promise of an insurance company or investment bank, but backed by option securities that are held in these funds. And this was, a few years after Lehman, many of the investors in the structured notes issued by Lehman were still fighting it out in bankruptcy courts. And everyone at the table at Cboe could foresee, and everybody agreed that it was very important to design the products to be really able to deliver on those target outcomes with precision, without compromise, without tracking error. That was going to be key, because if you issue a defined outcome fund but do not deliver on the desired payout, the advertised payout, investors would gravitate away from such, flawed investments back towards the guaranteed product. And with Cboe and other partners, we worked away over the following years to painstakingly build the infrastructure for these flex options backed defined outcome funds. And like we talked today, we have established track record of delivering on that outcome. And as I said, design is so key to getting that right. The small nuances that go into the product construction are very important to deliver that pleasant experience to the investor. All of that, I could say, we knew in advance. I will say, with full humility, that what no one around that table in 2012 could foresee was going to be such a big factor for the adoption of these products was liquidity. We knew these funds were going to, offer daily or intraday liquidity, daily liquidity for the mutual fund and the collective trust product, and intraday liquidity for ETF. But we kind of assumed that liquidity would be availed quite sparingly. Most defined outcome funds like structured notes and their RILA cousins are built to be bought at inception and held to the end of the target outcome period. And that's the design construct as we thought we could, that would be acceptable in the marketplace going back to 2012, sitting around that table. But today we know that liquidity actually offers very unique and interesting opportunities, both for buying and selling in the middle of the target outcome period. And the investors have really embraced that liquidity. And that, I would say, is an important factor on which defined outcome funds are very different from the guaranteed products, and I think is key to some of the success of the defined outcome funds. And so much so that we and our partners have built a lot of infrastructure to assist investors in navigating this liquidity, this intra-target outcome period liquidity. So I would say, looking back, thinking a bit on my feet up here, that probably is the most surprising learning for me personally in this journey.